The following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And it is Saturday, and we're going to be talking about money. We have a guest today, Kevin Briscoe of CFO Selections. Welcome to the program, Kevin.
Thanks for having me. I appreciate it.
Al's here, and we're going to be talking about 2025. Can you believe it? 2024 is not even halfway over, and yet we need to start thinking about 2025. And it doesn't matter whether it's Joe Biden who's elected or Donald Trump. There's major issues happening in 2025, and it's going to be a major discussion in Washington, D.C., and it could affect you and me. So the tax cuts of 2017, the Tax Cut and Jobs Bill of 2017 expires in 2025. And over 10 years, that would add $3.5 trillion to federal revenues. And with $3.5 trillion just sitting there, do you think that Republican or Democrats going to let that just sit and pay down the deficit, pay down the debt? No. I mean, if we did nothing, we would add $3.5 trillion and cut our debt by $3.5 trillion, or to cut deficits by that amount. And when you look at the situation, in 2023, we paid $658 billion in interest. And yeah, the Fed had hiked rates, so that had an impact. But even 2022, we paid $476 billion in interest. That's more. Over 10 years, that's an average of $350 billion. We're paying more than that in interest. That's more than we spend on defense. That's more than we spend on Medicare. And so that $3.5 trillion is already beginning to garner a significant amount of interest. And at the same time, that opens up a lot of questions about the tax code and what's going on. Over the past 10 years, there's been a big focus on pensions because 60 million people are not covered by 401ks. 60 million people do not have a pension plan. 52% of African Americans have no pension plan. 69% of working Hispanics have no pension plan. And with all that rolled in, that raises questions with that $3.5 trillion. I just returned a couple of weeks ago from the National Association of Pension Advisors, and there's a lot of discussion about what's going on. The discussion actually was very different than it was in the past, because in the past it was how do we get people into pensions? This time the question was, do we need 401ks? There's a question about that. The question is, does tax deductibility really get people to save more? If your pension wasn't tax deductible, would you continue to pay into it? Would businesses continue to pay for it? There was a second question that was raised in, do 401ks benefit only the rich and well-to-do? Do they only benefit if you have a shop where you have highly paid office workers and lowly paid warehouse workers? The warehouse workers, does it benefit them to the same extent it benefits the office workers? The question is that the pension plans are designed for the lower paid people. There was somebody that was profiled in October of 21, and that's been quoted. Diana Sanger, who helps take care of a grandson with autism, spent all her free time searching for a job after being laid off during COVID-19. She said, do you know what it's like to find a job when you're 70? No one wants to hire you, and you can't find a job with benefits and paid time off. Diana may be facing discriminatory prejudice, but employers also avoid older workers because they faced higher costs for employing them. Average monthly health spending per worker is twice as great for those aged 60 to 64 than it is for those aged 30 to 34. The News, the journalist Harry Smith asked Diana if she would ever retire. Her response was, I will die at my job. That's when I'll be able to retire. That kind of situation is appearing more and more before people in Congress. It's a very real issue. Needing to work in old age is one of the issues in this whole process. I mean, I'm old. I could have retired a long time ago, but I like what I do and I do it really well. I'm at the upper end of the scale. I have a choice. I could retire. I could walk out today and retire, but I choose to work. That's not true for a lot of people at the low end. That's an issue that's being discussed. $3.5 trillion on the table. Are there ways to help? There's arguments against the current pension system, which they call the 401k a do-it-yourself pension system. So there are proposals to bring back defined benefit plans, to force businesses into defined benefit programs for all of their employees. I think it would be a disaster, just as a side comment. I mean, Richard Foster, if nothing else, Richard Foster of Yale said that companies in the Standard & Poor's in 1920 had an average life of 70 years. Today, it's less than 15 years. That means that people going to work for some of these corporations are going to see their pensions essentially disappear after working 15 or 20 years because the company will disappear. And then, of course, the other proposal is to make Social Security the only retirement benefit and allow the government to manage it. All those things are coming up. The tax cuts expire in 2025, $3.5 trillion on the table. How does it get split up? Does it get split up? Does it come back? So listening to a couple lobbyists from the Republican side, they're looking at what projected revenues will be. And there's a tendency to want to just simply renew the tax cuts. Make no change, just renew, and maybe cut other places. Then, of course, there's the question of what they'll do in terms of deficit reduction. Deficit reduction is also on the table, and especially with a potential $3.5 trillion windfall. Do we call it a windfall? I don't know.
We're just getting our money back.
We're just getting our money back. The Democratic approach is actually far more varied. They want to reduce the deficit. And they want to use some of the funds to do that. But they also want to tax incomes over $400,000 to create additional revenue. They want to do more infrastructure spending. They want to raise corporate income taxes. And they want to keep the tax cuts for the low end of the scale. Cut those from the high end. But don't disregard the fact that the 401ks are also on the table. During a previous time, during the Reagan administration, the 401k contribution was at $30,000. Part of the tax reduction or the fiscal change that went on is they cut the deduction to $7,000, from $30,000 to $7,000. There's also talk in this whole thing of making Roth taxable. The money's supposed to come out tax-free. There's discussion about making all gains from here on out taxable, or even making the gains that have been made so far taxable. Think about that. So gains, which were supposed to be tax-free, could become taxable. What Congress gives, Congress can take away. That's really true. I know for us, we will quit advising people to do any Roth. That's our approach. But coming back to 401ks, looking at it a different way. Vanguard released their information on 401ks and the average balance. In 2007, the average balance in 401ks was $92,000. In 2017, the average balance was $103,000. So in those 10 years, it went from 92 to 103. That's a 13% gain over 10 years. Not that great. In 2022, the balance has grown to $572. In real terms, that gain from 2007 to 2022 is a negative return. That's the average account balance. The do-it-yourself 401k is under fire. 75%. Anyway, those are the issues that are going to be talked about in 2025. They're significant issues, and they're going to affect you and me and our pension plan. We think that we have an approach with our pension plans, but it needs to be designed and focused. One thing in looking at plans, 75% of all small plans have hidden fees. Some of those fees add up to almost 100%, or an additional 100% of what you think you're paying, and maybe over 100%. If you think you're paying 1% in fees, you may be paying as much as 3%. Actually, even if it was just 2%, an increase from 1% to 2% will drop the ending balance in your 401k by 17%. It's enormous. And think if it's 3%, what that does. Studies have shown there's trading cost, there's carrying cost, cash carrying cost. There are marketing costs. There are costs that are hidden that don't show up in the expense ratio. Up to 17 different fees have been identified. Consider something from a book that was written, the Money Book. Consider if an advisor came to you with the following investment, an investment of $100,000, ask you to take 100% of the risk, but if the investment makes money, The advisor and the firm get to keep 60% or more of the profits, but if it loses money, you get 100% of the loss. And you'll have to pay fees of 3 to 4%. Does that make sense? But that's what we're facing with a lot of 401ks. We're coming to a commercial break. Don't go away. We want to return to this. It's a major issue. It's going to be a major issue next year. And now is the time to prepare, not after it happens. Don't go away. We'll be back after this commercial break.
About Money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So I think I'm on a roll, so we'll just keep it rolling along. We keep going. So I mentioned Adam's Financial Concepts and our plans, and usually on this program, we don't talk very much about what we do, but I think with 401ks, I really do want to talk about, our focus in what we do is on plans that are less than a $10 million plan. It's the most underserved and the largest part of the 401k market. Most of those plans have low account balances. The balances that I talked about in the first part of the program, we see balances even lower than that. We see how can that prepare somebody for retirement? When you think about it, and I have the numbers here somewhere, for somebody that's making $15 an hour, and in the state of Washington, that's below minimum wage today, but for $15 an hour, that means the average wage is $300,000 plus or minus. If you add a monthly retirement paycheck of $1,000 a month through Social Security, that's $6 an hour. To reach a replacement paycheck, Social Security, add Social Security to the amount for the average 65-year-old of $195,000 means that the most they get to is 84%. As you go down and salaries become larger, it replaces less and less. Our focus is that we want to prepare people for retirement. And as I looked away, I lost my place in my notes. I will be there in just a second.
That'll give us a chance to do with that $3 trillion windfall that I'm sure is all going to come right back to us as the taxpayer, right?
There was a time when Republicans really wanted to reduce spending and curtail it and reduce the deficit, and Democrats wanted to tax and spend.
Right.
Now, Republicans want to reduce taxes and run up the deficit. Democrats want to tax and run up the deficit.
Well, nobody has a political will to do what Paul Volcker did, and things like that not Paul Volcker, but needs to be done to reduce the deficit, right?
Yeah.
To get it back down. We don't have anybody like that. They're both so busy fighting each other that there's no consensus.
There's a lot of talk, but no action.
Yeah.
So anyway, coming back, I found my notes. We took over a plan in 2016. In that plan, only the owner and his son had enough to retire. Every one of the other 18 employees, maybe it was 18 total, 16 other employees, not one would have been able to replace their paycheck. So we focused on that. We looked at that. The employer was actually making a significant match, 6%. That's a very high match. But even with a 6% match and the performance of the account, it just wasn't getting employees to where they needed to be. So we revamped the plan. We picked a different third-party administrator. We picked a different record keeper. And we changed custodians. We changed mutual funds. And we changed and offered a managed account. So the plan, when we took it over, had 56 different mutual funds, all from different custodians, all from different places. No real guidance. No. It was hard to figure out why there were 56 different mutual funds. It just seemed that giving everybody a huge choice seemed to be the focus, and confusion. And it was simply confusion. What do you invest in? And the previous financial advisor had been a fiduciary under the 321 fiduciary. And there's a real significant difference with that. We approach each account as a 338. Those are sections of the IRS code. A 321 says you are giving recommendations, but not advice. 338 says you're giving advice, not recommendation. The difference for the financial advisor is if one of the employees sues the plan, the advisor gets sued and is personally liable for losses. On a 321, if the plan is sued, only the sponsor of the plan is personally responsible. The advisor can walk away. With the new Department of Labor fiduciary rule, they're really spelling it out. There's a difference between giving a recommendation and giving advice. It's been kind of confused in the past with the major brokerage firms saying, oh, we're fiduciaries. We give advice. They can't say that. They can say they make recommendations, but not advice.
Well, maybe just offer a clarification, too. You mentioned being the plan sponsor. What you meant by that typically is the business owner. That is usually the sponsor. So it's a lot of personal liability. I certainly understand why over a period of time when they're just offering guidance and not real advice, they're going to kind of try to paint a broad brush picture and give lots of options with the idea that now I'm covered.
Yeah.
I said to my participants, they can have whatever they want, and if they make a poor choice, that's on them. It's not hard to find, or not hard to understand why it migrated direction. But to your point, it ends up doing a disservice to those.
Well, and I remember the hearing from an advisor who was actually giving advice, and the plan had been sued because there was a secretary who had been working for this company for over 30 years. She'd built up her retirement balance to over $600,000. Now this is 1998, so it goes back a way. And you remember in 1998, 1999 was the dot-com time, and all the young people that worked at the company were doing dot-coms, and they were making tons of money. They were just rolling in making so much money in their 401ks, rolling into mutual funds that had dot-coms. And she said, I'm getting so close to retirement, I'll just roll my money in for a couple of years and have a really nice retirement. Well, the crash of 2000 came, and she lost over 90% of her account. It went from $600,000 to less than $50,000. She sued the company, and she won. And it was the owner of the company who had to pony up the extra. Had that been us, I would have been on. And I can tell you, we wouldn't have done. Anyway.
You probably wouldn't have lost that money.
No.
Well, you can't stop the participant if that's what they want to do in a sense. Right.
So in our plans, we recommend 6 funds. Not 56, 6 funds. In this plan we recommend 6. We give the plan participants complete ability to do any one of 10,000 funds. So they have a complete flexibility. If they decide they want to do .coms, if they decide they want to do cryptocurrency, if they decide they want to do gold, if they decide they want to do whatever, they can do that. But we send them a letter and say, this is not something we recommend. It's your money. You can do with it what you want. It's not something we recommend. We consider that you're taking a lot of risk. We had in one of our plans, we don't do target dates, but one of the participants in one of our plans said she wanted to do a target date fund. She had an advisor who said you need to do target date funds because geared to mature to what you need. We said, studies have shown they don't do that. Studies have shown they underperform. We strongly recommend against it, but it's your money. You can do with it as you want. She said, I want to do a target. I said, okay. So we had to put target date fund, 401k. Do you know what? She never did invest her money in a target date fund. When she saw that the returns were exactly what we said, she decided not to do it.
Well, that's where a lot of lawsuits are being generated, is against firms having those target date funds in there that are they're expensive when they calculate them against the S&P 500 and say, hey, I could have been in the SPY, the S&P 500 ETF for 16 basis points, and you got me in this target date fund that's done nothing and cost me money.
Yeah, or they.
And the other problem with the target date fund, it just assumes as someone gets older that their risk tolerance is going to get more conservative. That's not necessarily the case. Just because I'm closer to retirement, I still might want to take a little bit more risk than what the target date fund has me allocated. And if you calculate that today, Mike, especially with what's happened with bonds, can you imagine if you went to 60-70% bonds and you were 3 years away from retirement?
Oh yeah,
terrible. Your return would be terrible. If you'd stayed in the S&P 500, you'd be like you would have been done much better than being in a 60-40. If you were 60-40 bonds at the.
Oh yeah, I mean target date funds in theory, if the market went up a quarter of a point every day, day after day after day, and if bonds continued to pay and the prices never fluctuated, that'd be wonderful. I mean, they're built on what's called a glide path. This is what you have now. This is what you're going to be adding. And at the end of the time, this is what it'll be. And we'll allocate your funds more into bonds as you get older and less into stocks. And everything should be glorious and wonderful.
Oh, yeah.
And it's Wall Street guys that brilliant Wall Street people that have dreamed up this thing, and their Fidelity is predicting 80% of 401ks will all be in target date funds. I would hope that not one of ours. But we do have one with target date funds.
Well, it's like you and I have been trashing the private credit and private equity fund. I don't know if you're familiar with these, Kevin.
I'm not. No.
So
I'm familiar with the target date, not the private equity.
So Mike and I go to these seminar, these like investment seminars people put on, and they're trying to get us to put our client into funds, just like the 401ks are trying to get us to put in a target. So they're pitching private credit. Basically, it's a fund that'll pay you like 11 or 12% income, and you're buying interest in the companies that are non-public. We'll continue with this when we get back.
Okay.
About Money with Mike Adams on AM 1300 The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
So before we left, I was explaining about not target date funds. We went from target date funds, and I was talking about private credit somewhere that we're getting pushed into putting our clients into these type of funds. And I was explaining to Kevin you're basically buying interest non-public companies. And the way they pitch this is that, we have control, and it's actually safer than dealing with public companies. But think of it this way, Kevin. If you were to bring a CFO to a business, and that business went to one of the larger banks, and the bank said, no, we're not going to give you a line of credit. But then some other non-bank financial institution stepped in and said, hey, Kevin, we got money we can loan you, right? Yeah. Hey, and that's how that works. So what are they charging that business, right? If they're paying me 11.2 or 12.2%, that's what they're telling me they're going to get this payout, and my money's locked up for 10 years. So if I give them $100,000, my money's locked up. What are they charging that business for that money? And if that business is basically is essentially like a subprime home back before 2008, lender.
Right. It's an interesting. You can follow the thread. I think our business owner listeners would say, I think the thing I have the most control over in terms of how I make money is my own business.
Yep.
Most small business owners will say that, right? So in that sense, the idea of a business being the driver of wealth probably resonates a bit. But you don't have to get too far removed from, and this is really to your point, Al, the control is not with where they're suggesting the control is. Private equity is simply an investor. The businesses still have to perform, and if you're charging them 3 times the average rate of capital, their return is not going to be sustainable.
So right? I sat in a CNBC. They had a big online meeting thing, and they said, you want to join? I said, they had a big thing about private credit. There's one guy from private credit. I said, I'd like to listen. He said his firm is one of the 5 original firms, and they have about $75 billion just under management. They've been doing it a long time. They've been through several credit cycles doing this, so they're pretty good at it. I said, okay. Well, that market, Kevin, has gone from about $20 billion in 2000 to it's approaching over $2 trillion today. I said, okay, so if there's 5 really good firms, you're telling me, you got $75 billion. Let's say there's $100 billion to make the math easy. That's $500 billion that I can say I can pretty much trust. That means it's $1.5 trillion that I have no idea who the players are. And these are non-bank financial institutions, so banks are getting involved, lending them the money, right? Now the big bank is lending these people the money with no regulation, and now they're pushing the regulations they're pushing it further to get these to lend more money to these businesses to drive profit. What does that sound like?
Yeah,
it sounds like to me. But then again,
what do you know?
So that brings us to your business. Tell us your background. This is Kevin Briscoe of CFO Selections. He also has a couple other businesses, but let's start with CFO Selections.
Yeah,
why don't we start with your background?
Sure. As I just mentioned, I'm recovering and can qualify as now a business owner. Started my career in Fortune 100 right out of college many moons ago, and quickly understood, at least from my own personal match, when I migrated out of. I've been in the Puget Sound my entire career, so even that Fortune 100 time I did here in the Pacific Northwest, and then migrated into a couple of different businesses. We were talking earlier about the dot-com era. I dropped into a tech company in the 90s, like everybody did in the 90s, and it lasted about 2.5 years before I had to move on to something else, but then became a small business owner in a sales organization that led me to an opportunity to at least initially become a practicing consultant at CFO Selections, doing financial advisory work, very different than yours, CFO work focused on small to mid-market companies. And I did that for about a half a dozen years before moving into firm leadership. And now, having been the managing partner of CFO Selection, up on 9 years.
That's beginning to sound like it's real.
It's becoming something real. I can certainly say it's nearly 17 years ago that I started in the fractional CFO space. And those early conversations, there was a lot of work laying out expectations of how does this work and what do you do? What do you mean you're not going to be my employee? How can you manage my money and not be one of my employees? I would say today it's a very different conversation. Most business owners understand that is a a la carte service that's available to their business. They concentrate more on who is it that is going to be here offering their insight and guidance into helping me run my business. How relevant? What does that look like? Certainly, as we have matured and grown, our ability to be more aligned with the client right out of the gate is much, much better. In my day, there were 13 consultants on the team, so you pretty much took whatever came through the door next. And I got to work in a lot of industries as a byproduct. Today, we apply a lot more scrutiny to what the clients, the nature of their business, what their needs are, and do a lot of matchmaking, make sure that we're bringing them a relevant resource that can really bring some value to them right out. Quick example, a nonprofit consultant, generally fund accounting oriented, often mission aligned, because that's how those organizations are primarily driven to function, but not necessarily a profit motive in a nonprofit environment. They may have some fee-for-service type work, things of that nature that they do, but at the end of the day, the proceeds are going to be plowed back into that organization, and the skill set that a CFO has is very different than an early-stage, venture-backed SaaS revenue startup that's taking money from other people and needing to optimize early on their use of capital and how they're going to drive their revenue. It's all debits and credits, but they're doing very different things with those debits. And that's one of the things that our organization tries to.
So go back to the original questions.
Sure.
About a CFO, a part-time CFO that's not a W-2 employee, but a 1099 or a consultant.
Yeah.
How does that work?
Yeah, in our case, the biggest distinction is we're not taking on fiduciary responsibility for the organization, which typically a small business owner doesn't want us to do anyway. It's their business and it's their money. So we're very much in an advisory capacity. But the bona fides that our team brings to this organization are generally, I won't necessarily say speaking for themselves, but they certainly support the credibility of why that advice will be. I'll give a very simple example. And this is still true to a degree today. Lots of businesses that get started in the garage and become successful, I'll just use round numbers, 5 years ago they're doing $1 million. They've grown into $10 million, and the complexity of how to manage that financial environment is exponentially growing along with their revenue. The standard business owner understands how to drive whatever it is that they're selling. They may not understand what's happening internally to the complexity of their financial structure, along with some of the administrative and operational aspects of running their business. I'll dovetail this back into, say, for example, managing a 401k plan. CFOs often are involved in vetting those, getting those put in place, making sure the compliance elements are in place. It's one of the many things that often fits under the umbrella of the CFO. And in our world, those are the kinds of things a CFO would bring to bear as advice guidance to help out that business owner. It's also why I mentioned this term early. I called it a fractional CFO. The bulk of the work that we do is not full-time, 40-plus hours a week in aligning with these small businesses. Number one, they can't afford it. And number two, they generally don't have a need for that high level of expertise at that type of hours. A day a week can bring a lot of value from someone who's been doing this work for 25 years.
But a lot of these firms, they have a CFO already, right?
They won't necessarily have a CFO, but they will have financial staff,
right,
typically.
Right.
Maybe it's only a bookkeeper. Or it might be a controller and a staff accountant. Certainly depends on the nature and the size of their business. What that CFO is doing is layering in a level of expertise that tends to try to shift the business's focus to the forward-looking areas that they're headed to, spending time thinking about what risks are we heading up against? What do we think our cash needs are going to be? It's all down the road. Contrast that with what a controller and other accounting staff typically do. They are looking in the rearview mirror. They're reporting, they're dealing with compliance elements, they're making taxes are filed with the city, state, and feds, things of that nature. Those are all important and they have to be there as well.
Right.
But that CFO is tending to want to veer you forward. Look at where you're headed. Try to drive through your windshield, not through your rear view.
And so what size business usually begins the CFO process?
Yeah, no, happy to talk about that. It's, as you might imagine, the range of business we serve is actually anything from 5 to 50 to 100 to 200 million may only need the benefit of a fractional CFO. It depends on the nature of their business and their complexity. And one of our hallmarks is we want to be an a la carte offering and not superimpose what we think is appropriate for your business. We want to respond with the needs of that organization specifically. But there needs to be a bit of scale in order for the value of a CFO to really bring to bear anything of consequence to that organization. So that's why I use that $5 million revenue as kind of a target. I mentioned earlier we do nonprofit work. Sometimes that's thinking of annual budget. 3 to 5 million is probably a better guess for those. For-profit industries, 5 million is kind of an entry point. We certainly have clients that are smaller than that, but it's not. And then again, scaling up from there based on maybe it's a day a week, it's 2 days a week. It's really going to depend on the portfolio.
And does it depend upon the type of business, a manufacturing versus service versus whatever?
The resource we bring, it certainly depends. As I mentioned earlier in my example, the skill set for each of those can be very different. I'll pick up on your manufacturing. It's generally going to be a very cost-oriented, cost-heavy, inventory-driven organization. The skill set for accountant and finance people managing that is different. Again, nonprofit in the early stage fundraising. It's yet another iteration. But it's going to move all over the place relative to the skill set and background of our. We're very intentional about making sure that we match those skills to make sure we're not giving somebody who fish out of water into.
Yeah. In that case, are there times when you have 2 CFOs?
It's uncommon. What we might bring a CFO in who's the right skill set, who could work on something, and another CFO to work on a specific project.
Okay.
But they won't be playing the same role in the organization.
We'll be coming right back.
All right.
Stick with us. There's more to come.
About Money with the AFC team, Mike and Al on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So we're here with Kevin Briscoe of CFO Selections. We want to talk about CFO Selections itself. You have a number of offices and a number of CFOs that you with. Tell us about that.
Yeah, sure. Originally founded in the Puget Sound, as I mentioned earlier, and so we have a fairly substantial office here in this market. We've been in Portland about 12 years, so also serving the Oregon market, and we entered into the Colorado market about 2.5 years ago, so we're in our 3rd year in that market as well. Across those markets, we have about 125 consultants with a variety of different backgrounds working in each of those locations. As you may imagine, the bulk of those are in the Puget Sound region, not quite as many in Colorado in our 3rd year as we're growing that practice. And we're beginning to look at additional markets as well. Hope to have an announcement before the end of the year of where we'll head next.
Not Bangor, Maine, right?
It's not going to be Bangor, Maine.
Dang.
I know, surprisingly. I think the thing that's a little unique about our offering, though, and the reason we talk about the market specifically is our offering is really more of what we call a hyper-local presence. The small to mid-market companies tend to want to have not only face time with the organizations we're working with, but a real relationship that gets built. And many of the organizations that we go to work with, we stay engaged with I can measure it in years, not weeks and months. We certainly do interim work. If you lose a CFO or a controller and you need somebody to come in and keep the trains on time, we can do that. If you've got a specific project, we can do that as well. But the vast majority of the way we're engaging with our consulting offering is we are in there on a regular basis with an expectation we're helping you over time to guide your business. And I'll throw in just as an adder, because we do this as well. It's a smaller piece of the business, but we do permanent placement work for CFOs as well at CFO Selection, as I have done that for several years. That tends to be a little larger organization that have full-time CFOs that we're aligning with, so it's not an exact overlap with consulting practice. Certainly a lot of crossover.
So you have other businesses too. Let's
We do.
talk about those.
Yeah, no, I appreciate that. So it will probably not surprise the listener that we have a tactical resource in the accounting space as well. We brand it separately. It's called the ASP team. ASP once upon a time was an acronym that nobody understood and could remember, so it's just the ASP team, theaspteam.com to get to it. And it is your assistant controller, accounting manager skill set, all the way down to professional bookkeeper and every professional accounting role you can think of. Businesses need to have those in those organizations. And if we're bringing in a fractional CFO under the CFO Selections brand and they have their existing staff, that's perfectly fine. We're happy to work and collaborate with that organization. But lots of businesses don't, and they don't have either of those. And the reality is, you don't need to be paying a CFO to book journal entries and do cash reconciliations that need to happen every single month. There are professionals that are much more capable, quite frankly, than most CFOs of doing that kind of work, and we want to align those kinds of activities with those individuals. Our difference compared to lots of outsourced accounting resources, though, is we do that very a la carte, and we make sure that we're only giving the client what they need under each of those circumstances, and therefore the two brands associated with those two offerings. And then lastly, in the CFO family of companies, we do have another offering. It's called Vaultus that operates very similarly to the other two, where we have outsourced consultants and permanent placement resources, only in this case they're focused on the nonprofit community, which is a big part of the work we do at CFO Selections and ASP as well. And they do interim executive director work in that nonprofit space. So it's that lead executive and helping businesses in the nonprofit space that are looking at transitions in their leadership. In the Puget Sound here in particular, there is a tremendous nonprofit community, thousands of organizations serving a variety of causes, and many of them have founder leaders that were a part of getting these nonprofits off the ground that are 18, 20, 25 years into their career stewarding these organizations, and they're ready to transition. And that generally falls upon the board to try to figure out who is the replacement going to be. Vaultus is here to kind of step in as an outsourced resource to help with that process. They not only can bring in the interim executive to help navigate a conversation with the board about what the next leader should look like, but they can then help find that permanent. That's the family of companies. I appreciate the chance to talk about this. Thank you.
Well, that's great. So talk about, the business prospects or the potential businesses that would be using the ASP group.
Yeah, sure.
I have to be careful how I say that.
That's why I use every letter, ASP. That way I stay out of trouble. The reality is almost any organization is relevant. I offered headcount for CFO Selections. At ASP, we have approaching 170 resources under that brand across the markets that we mentioned. And just to close the loop, Vaultus has about 25 folks across the markets that can work as interim executive. At ASP, a wide range of potential organization, tending to actually go all the way up market beyond that small to mid-market space that we can work. We don't fancy ourselves as a staffing firm. We're not competing with the Robert Halfs of the world or like that, where they're going to grab full-time resources to come in and be a staff accountant. That's not what we're built for. The folks on our team are very tenured professionals, at least 10 years, but typically 15, 20, 25 years as financial managers, even at ASP. These are folks that have chosen this as their career discipline, and they are focused on serving typically more than one client. At ASP, it might be 4, 5, or 6 clients, depending on the nature of their portfolio and how much they're doing at each location. And they're bringing to bear a professional persona and application of their skills into those environments. And it's all of the businesses you might envision: manufacturing, distribution, professional services, construction businesses. I mentioned nonprofit earlier, early stage support. It's all relevant for those tactical accounting resources as well. All of those businesses at some point need that same level of support. Quite frankly, businesses need that before they need the CFO.
Yeah. So in our case, for example, my wife does the books. And
probably does a great job too.
And I mean, it's not a full-time job. It's a part-time kind of thing.
Right.
But at some point, as we've, at one point there was just me in the business. Then she came. Then we've added people. At some point, as that grows, do we shift to a part-time bookkeeper?
You might. A lot of times the way I like business owners, or I'll advise business owners to think about it is, what are the facets of your business that cannot be migrated to someone? There are things about what you do for the organization that you're stewarding that are really, they need to stay central to the ownership themselves. Accounting is one of those things that doesn't have to stay with you, right? If you're looking to load shed responsibility to get other things off your plate, debits and credits is a universal language. It gets applied differently in different businesses, but it is a universal language that a third-party third-party professional, very capably steward for any business as they move forward. It's one of those things that it may not simply be, I've grown to the point where I need to offload it. It may simply be, I've got other things I should focus on. This is one I can hand off to somebody. The same thing applies to the CFO work. Lots of business owners do the cash management. They do those things in their head as the thing is scaling. They just have a feel for it. Eventually it gets to a place where you can't do it in your head. You really do need to bring to bear some skill in it.
Well, I think in our case, we want to travel. We are
There
beginning
you
to
go.
travel. Being gone for 2 weeks or 3 weeks or 4 weeks and having somebody that can do that, fill that spot.
In our world, we all know that the state of Washington comes looking for their little stipend in the B&O tax return every single month. Somebody's got to get that done.
Somebody's got to make payroll. Somebody's
That
got to pay the invoices that come in. Yes, all that has to happen.
Yeah.
So anyway, it's interesting. It's great to know that service is available. So give us, how would people contact you?
In both cases, I'd point them at the website, cfoselections.com, if that senior executive is of interest, theaspteam.com. We'll point them to our bookkeepers and accountants, and vaultusgroup.com is that interim executive director offering. And I like to mention that a lot of times because lots of business owners sit on nonprofit boards, and that's helpful to them. So, appreciate the chance to share those.
That's
Thank
great.
you.
Thanks for being on.
Yeah.
Thanks, Kevin.
And we'll be back next Saturday, because if it is Saturday, we're going to be talking about money. Take care. Have a great week and weekend.
You've been listening to About Money with registered investment advisors Mike Adams and Al Souza. If you'd like more information about what you've heard today, or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1300, The Answer. The preceding program was sponsored by Adams Financial Concepts.